We are now moving to our final session of the day, which will cover home insurance, property insurance markets, and is moderated by Bruce Kane. Bruce is professor of political science at Stanford University, director of the Bill Lane Center of the American West. He perhaps understands the politics of California and the American West better than anybody I have ever met. He's an expert on wildfires and the surrounding political context that I think we all recognize is first order. Thanks for being here, Bruce. I will turn things over to you.
As Neil says, today the last panel is going to pick up on topics that were sort of alluded to, but now we're going to go in some greater detail. As I listen today, I think one big question, which we're going to, I think, cover today in this last panel is, how exactly do we assess the physical risk? And actually, CAL FIRE has that responsibility of figuring it out. And they have zones, very high hazard zones, high zones, safer zones, et cetera. And that's like the flood zones. It's an issue that people don't like being classified in a more risky zone because it affects their finances. So everything here is going to come down to finances in our discussion. So it's a very controversial thing they do, and a lot of the measures that they have in terms of clearing the brush around the home, as people have mentioned today, are expensive as well. A second question then is, how do we get people to do the things that we think they should do, to actually do the clearance around their homes, to buy the insurance that we think they need? Because one of the problems is if you put the insurance rates up, and I know this from a dinner party I just had the other night where a fellow faced in Orinda with the rising insurance decided that he won't cover himself with insurance. So that's going to be a big problem. Now you can think of three ways typically that we get things done. One is to give them information, and we do that, but that only gets you part of the way, as we know. So that's it's not terribly effective, but it's easy to do politically. And then there's compulsion, which is hard to do politically but is very effective. But it's not easy for the political sector to tell people thou shalt do all of these measures and by the way, deal with the electricity costs that are coming with the wildfires, but also with the electrification of the system. So that's a tough one. So what's left is hopefully it won't get killed in this panel, the possibility that we can use material incentives, insurance, and mortgages. So that's kind of where we're headed. And then a third area, which I think I'm hoping Stephen will bring up, is how we reconcile this with the need in this state to build more housing. But how do we do that in a safe way, given that about 40 to 45% of the land is federal land of various sorts, and then the state has lots of land. So we have very dense concentration surrounded by WUI land, which is a very difficult problem. Okay? So in order, we will start with Frank Bigelow, who is with CAL FIRE and has had, I think, over 2 decades of experience, including on suppression, and now has been working at a broader level in Sacramento. And then we will go to Stephen Greenhut, who is someone who writes extensively and does research extensively in a think tank on a lot of issues related to wildfire and has thought a lot about the housing issues, so hopefully he'll weigh in on that at some point. And then we have 2 people that have really thought very seriously about these economic instruments, both in terms of the mortgage markets and the insurance markets. And so this is, I think, a really important question of how we price in all the risks that we've been talking about today, and these deeper questions of, should we even be insuring them at all? Because there's a moral hazard problem, right? The safer they feel, the more the people will move into this area, the more difficult the problem. So there's a lot to deal with. But let's start with our first speaker, Frank, and he can say a little bit about the CAL FIRE perspective.
All right, good afternoon. My name is Frank Bigelow, and I am the Deputy Director of a division within the Office of the State Fire Marshal at CAL FIRE called Community Wildfire Preparedness and Mitigation. So on behalf of our State Fire Marshal, Daniel Berlant, who was supposed to be here today, who got summoned to the legislature for a hearing today, wasn't able to make it. But I would want to provide you an overview of CAL FIRE and our efforts for advancing wildfire mitigation and preparedness. So let me start off by thanking the Stanford University for hosting such an important event. And just on the screen, you just see how we're made up in the Office of the State Fire Marshal. Chief Berlant up there, then myself and Vicki Sakamoto are the two deputy directors that serve the Office of the State Fire Marshal. California has made major investments in wildfire mitigation efforts that play a crucial role in our strategy for combating wildfires in the state. And I'm going to talk about a lot of those investments here over the next couple of minutes. But I want to start off by saying, who is CAL FIRE? And a lot of people think of the planes and the red flashy things and putting out fires, which is a lot of what we do. We have 12,000 personnel, 356 engines, 60 bulldozers, 155 fire crews, military crews. We have 14 air bases, 11 helicopters, 23 air tankers, 12 S-70I helicopters, 16 OV-10 airplanes, 12 Super Hueys, 7 C-130 airplanes. The largest wildland firefighting fleet in the world, rivals some military fleets of countries in the world. So it was mentioned, and thank you for saying those nice things, Marshall and others, thank you. Yeah, we feel like we do a good job of putting out wildfires, and because we've had to get good at it. We've had a lot of wildfires, which you've heard all day. And where we're turning the attention to now is to mitigation and preparedness and getting people involved and engaged. And so we are so much more than those resources that I listed off to you. Some of the divisions that make up the Office of the State Fire Marshal there that you might not be aware of that we also do. But in addition to that, we have a resource management section that has entomologists, pathologists, archaeologists, geologists, all the ologists that work on environmental review, environmental compliance, and CEQA, ensuring that we are good stewards of the land, that we do natural resource protection, because that's a paramount part of who we are. And it's by design that we are called the California Department of Forestry and Fire Protection. We are now known as CAL FIRE, but we are still CDF, which is the best 3 grades I got in high school. So that's why I joined. I felt a kinship. So I'm going to start off by what are those wildfire mitigation efforts that I mentioned? In the past decade, over 70,000 homes and buildings have been damaged or destroyed by wildfire. And it's a staggering fact that homes that ignite by wildfire have a 90% chance of being destroyed. The reason for that is there's not enough resources to be at every single home when we see fires like we saw in Camp and Tubbs and in Paradise and Eaton, and the list goes on and on. The resources get overwhelmed, and we can't put an engine at every house. The best way to stop houses from burning is to put the fire out. So we need to put the fire out. But I want to stress we have a strong plan to make California a more resilient state through our California's Wildfire and Forest Resilience Action Plan. So today I'm going to focus my comments on defensible space and community-level mitigations, but it's important to note that we need to address our wildfire crisis. It's a 4-prong approach. Strong fire protection response, check. Forest management, I think we're doing a pretty good job in the lands that we steward. Community-level preparedness. We need to focus more on community levels, more awareness, more engagement, and parcel-level mitigation around homes, directly around homes. It has to be an all-of-the-above approach. So next I'm going to focus on defensible space. And for decades, California is required by law in wildfire-prone areas to remove dead and dying material, vegetation 100 feet around their home, as well as provide spacing from plants, bushes, and trees. This is what we call defensible space, so clearing that vegetation. The goal is to keep a wildfire from burning right up to a home and provide a safe space for firefighters to work in the event of a fire. A lot of science and research has gone into the requirements. While the mitigations have made a measurable difference in protecting homes, we have learned through research that the first 5 feet around a structure continue to make homes very vulnerable. So right now there are 2 zones, Zone 1 and Zone 2 for defensible space. We're adding a 3rd zone, Zone 0. That's where you see in the red around the home. It's the immediate 5 feet around your home. We've partnered with a number of organizations, academic and research groups, to ensure that the wildfire mitigations, including Zone 0, is research-backed. It's important to note that maintaining defensible space is the responsibility of the resident. That's, as a homeowner in the state responsibility area and in the very high fire hazard severity zone of the local responsibility area, it's required by law that the homeowner maintain that defensible space. But to help Californians in their compliance, we have 50 full-time, seasonal, dedicated defensible space inspectors, seasonal and full-time, that help homeowners understand, educate them about home hardening, which I'll talk more about, and defensible space within CAL FIRE's responsibility. And they provide the resident on steps on how to make their home compliant. Because oftentimes people are like, well, where do I start? It seems like a daunting task. Like, what's the most, if I'm gonna focus my effort, where do I need to start? And our inspectors can help them do that. We've set an internal goal every year to reach 250,000 inspections. I'm happy to say last year we did 299,973. I was really hoping for 300,000. We just missed it, but hopefully we'll get there. This year we're on target to exceed that, so that's exciting. The goal is centered around the effort to visit every home in the state responsibility area every 3 years. We're working on trying to bolster our staff so that happens on a more frequent basis. But in fiscal year, as I mentioned, we did 299,000, very close. Our focus is on homeowner engagement and education. We get about 82% compliance on a first inspection for defensible space, which is really important. That means that people are buying into it. And then you have two groups in that last 18% that about 9% have say they can't do it physically, financially, whatever. And then the other 9% say, I'm never going to do it. You can't make me. So it's a matter of education for those folks because the other ones get it. So it's not as daunting of a task as it seems. But I'm very excited to announce that earlier this year, we created a defensible space dashboard on our website, a public-facing dashboard to show, in essence, where those inspections are taking place in an area. And that's publicly available now on our website. We have made great strides in recent years to increase the number of inspections of homes in the state responsibility area by bolstering what we call a qualified entity program to force multiply. So that's resource conservation districts, fire safe councils, Cal volunteers, 3Cs, and others that can help do assessments for us out in the wildland, which has been fantastic. Moving on to home hardening, and oftentimes people say, well, how do you make your home harder? Like, what does that even mean? So those things those arrows you see on there kind of point you to the areas that we're focused on to try to make homes more resilient to wildfire. And that's things like eaves, vents, windows, siding, roofs, that are very important. And it's essential that those things be fire resistant. It was mentioned on the last panel about Chapter 7A of the Building Code, which we're very proud of, which is the most progressive in the nation. We've recently been able to pull different parts into Part 7. So it will now be known as Part 7 of the Building Code. So it's all in one place. There have been pieces and fragments of these wildfire mitigations all over. Now they're all in one place, and that will start in January 1 of 2026. We've also been able to lobby the International Code Council to get what was known then as Chapter 7A as a part of the international code that all states in the United States will have to follow. And we're working through that process now because we know through the data that we've collected, through the research we've done, that it does provide the homes the most effective chance of surviving a wildfire. About 90% of the homes in California in wildfire-prone areas were built prior to WUI codes. WUI codes went into effect in July 1st of 2010. And so we have a huge housing stock that was built before that are susceptible to wildfires. And we saw that most recently in the Eaton fire and the Palisades fire. Most of those homes were built in the 40s, the 50s, and the 60s, and very susceptible to wildland fire, unfortunately. As far as for insurance, I want to mention that we have worked alongside the insurance commissioner and many other stakeholders to align wildfire mitigations. The Commissioner's Safer from Wildfire framework is based not only on science, but our requirement in California. While insurance obviously has become a very hot topic, our work with the insurance industry has aligned our mutual goal in reducing wildfire risk in that matter. So just in conclusion here, and we'll have plenty of time for questions in a minute, to protect communities against wildfire, it must be a tiered approach with public engagement. With the peak of our wildfire year ahead, it's critical that all Californians take steps to, and these are some of the other, forgot to click the things that we have done. And I did want to mention the research before I finish my last statement here. What you're looking at is an image from some research that we're sponsoring from the Insurance Institute for Business and Home Safety. It's called a Structure Separation Experiment, or SSE. What we're looking at is buildings like you would get auxiliary structures that you would store your material in, and the distances that it need to be away from homes to make it effective. And oftentimes with short setbacks, and we have the room to put the building, but should we put the building? So this building is at 20 feet away from that home. And what we saw with a 12-mile-per-hour wind on that, you can see all the instrumentation we have on that target structure from the source, which is the fire. It was a 16-foot long by 8-foot wide, I guess I'll use the word tough shed, even though it's a brand name. And it was blowing toward the home. The windows failed and fell out, vinyl windows. So in this structure separation experiment, we're building full-scale homes and lighting those things against it, but we're also checking the siding, the vents, the eaves, the gutters, every component that we can, and at varying distances, at varying wind speeds, to determine what the most effective distances are. It's a 4-phase approach. We're in phase 2 now, and we'll be publishing, as soon as that is done, at the end of next year, the results, and hopefully that will inform codes and regulations moving forward about exactly for accessory dwelling units, which is the next phase, and then full-scale home distances away from each other. So this is a multi-phase process to inform regulations. So again, with the peak of our fire year ahead, it's critical that Californians take steps now to prepare for wildfire. And I thank everybody for your attention in this, and hopefully we'll have time to answer some questions in a little bit.
All right, let's go next to Stephen Greenhunt, who is a resident senior fellow and Western Regional Director at R Street.
The other day I was, well, not the other day, a few months ago, I was in a meeting and I see a phone call. It was from my insurance agent. I'm like, oh my God. And, you know, insurance agents aren't used to being the most feared people in the world. And he didn't appreciate my calling him that. But it turned out that the insurance company on one of my properties, they wanted me to do brush clearance, which is thankfully, you know, I was able to do that and didn't lose my policy. But we're seeing, obviously, that insurance, which is one of those I'd rather be cleaning out my sock drawer policies. People are talking about it. I mean, normal people, neighbors are talking about it. So it's impacting average people. So I just want to start with a random quote, you know, thanks to Google. There's never any justification for things being complex when they could be simple. So I think the insurance issue, I mean, when you talk about it and people get really, you know, their eyes do glaze over when I want to talk about insurance, which I do find somewhat interesting, but it's just this miasma of regulation and complexity, and really, it's a pretty simple issue. Insurance is just a product, and we need to let insurers set the product to reflect the risk, and then we get more competition, and that's how we do everything, right? Well, not everything. California, we don't do that on housing or any other number of issues. But on your normal, you know, iPhones or whatever stuff you buy, it's just set by competition and market. So anyway, there's a proper role for insurance regulation. So I'm not somebody saying, oh, just we need anarchy in the insurance market, and no actuary would really endorse anarchy. But the Insurance Commission needs to make sure that insurance companies have the reserves. This is the standard way, the reserves to pay any claims, and that and to fight fraud. I mean, right? But instead, in 1988, the voters, in their infinite wisdom, passed Proposition 103, essentially provided price controls, so a prior approval system. So imagine in your business, anytime you wanted to adjust rates or prices or anything, you had to go tail between your legs to the insurance commissioner. By the way, it turned the insurance commissioner into an elected position, which you could guess what the incentive is, right? Insurance commissioners do not want to be, and this is Republican or Democrat, it doesn't matter. They do not want to be the ones who approved a huge rate increase, because you know how that would go in the next election. And I don't know really I can't think of any insurance commissioners that actually wanted to be insurance commissioner. It's not like, oh my God, I want to regulate insurance. And then it also allowed the insurance commissioner to roll back rates, which of course they did. And anyway, this has been going on for years, since 1988, but then we had a series of wildfires that were particularly bad, 17 to 2020, 2023, and some of us have actually been warning about it. You know, the impending insurance crisis, I think that's one headline I wrote, and I'm a newspaper columnist also. We're not that prescient. I mean, we're just looking, oh my God, it's pretty obvious. But State Farm stopped writing new policies, and State Farm's 21% of the market, and then others followed, and then we had the insurance crisis. So anyway, that a lot of the LA area homeowners have become heavily dependent on the FAIR plan, which is the Fair Access to Insurance Requirements plan, because they have trouble getting insurance. So it's the state-created plan. It's backed by the insurance industry, but it's bare bones. You don't want it. It has 3 times the number of people on there, and it's at the risk of insolvency. So that's not an insurer that you want. But of course, when the state does things, they don't anyway, they get a pass there. So anyway, we have seen this for years. The governor, the legislature, they're smart people. They know this has been going on for years. They managed to have time for an emergency session to figure out why gas prices are high. Like, we don't know that it has anything to do with all these many other things. But they didn't have time to have an emergency session on insurance, even as this crisis has really been unfolding and getting worse. So Ricardo Lara, the current insurance commissioner, he was late to the party by his own admission, but he did arrive, and he's done all the right things. I made the mistake, well, it wasn't a mistake, but I praised him in a column, bad timing. It came out the Sunday before the story broke about his rather impressive travel schedule. But I do defend his trip to Bermuda. That's where the reinsurance industry is. I mean, that's where you go. But other than that, I don't know. But still, what he's done, and I got a lot of flack for that, but I keep saying, tell me one other thing you would have liked him to have done that he hasn't done, at least however late, but he's done it. So he's sped up the rate reviews. Prop 103 really pushed for a 60-day rate review, and it takes like about a year now. And so he's pushing for 60-day rate reviews, and then the bureaucrats have to provide their justifications if it's going to run past that timeline. It allows insurers to factor in reinsurance costs, which have been rising. And reinsurance is the insurance that insurance companies buy. But the more reinsurance they buy, the more policies they write. And that's the goal here, right, is to get them to write more policies. So he did that, allowed catastrophe modeling, which is pretty important when you consider if we're concerned about climate change, and that seems to be the major concern in state government, you ought to allow insurers to model for future problems rather than just past rate issues. He came up for a plan if the FAIR plan fails. So now the insurers are on the hook, of course, but at least they know how much they're on the hook, so they could plan. So those are all wonderful things. He also has okayed every rate hike, which that's come before, maybe not for the entire amount asked for, but that's what needs to happen. And anyway, so that's a good thing. Oh, and then while he was in Bermuda, he announced that he was going to take on intervener fees. Now, the intervener fees are the fees that insurers have to pay to trial attorney consumer activists who basically oppose their rate hikes. and basically hold the whole rate process hostage and drag it all out. And he said he even used that holding rates hostage thing. So anyway, that's good news. Those are good things. And as a sidebar, in 2020 wildfires, which weren't as bad, I don't believe, as the latest ones, erased double the emission reductions for the past 16 years. So we have to do something about it if we're serious about climate change, about wildfires, and if we're serious about wildfires, we have to fix the insurance situation. Another sidebar, and just to give you an idea how nutty the intervener fee situation is, in 2016, State Farm asked for a 6.9% rate increase, which is the top amount you can ask for. Then Commissioner Dave Jones instead rolled it back 7%. Wow, that was, this dragged out, this created a legal battle. State Farm won in court because the commission was using pretty squirrely revenue estimates. But they still had to pay almost $2 million in intervener fees to the people who dragged out the whole process. It doesn't make sense. It needs to be reformed. So anyway, the latest package of reforms, the sustainable insurance strategy, it seems to be working a little bit, even despite the LA wildfires. We have 7 insurers who've said that they're going to expand underwriting, so that's progress, still a long way to go. So basically, it's simple. Let prices reflect the risk, or we get scarcity. So we're going to have higher rates now. But when I renewed my home policy, I didn't care what it cost, really. I just wanted to make sure I had a policy and not on that god-awful FAIR plan. And higher rates are better than no insurance. And then competition comes in, right? Price controls always destroy competition in the long run and raise rates. So then we have competition like any other market. And I understand why voters supported Prop 103. They were rapidly rising, mostly auto rates, but that was the result of the Royal Globe Supreme Court decision that allowed third-party lawsuit, punitive damage lawsuits. But anyway, it was an insurance-driven. It was a court decision that created the problem. It wasn't a market failure. So we have to let the market work. I'd love to go back to the voters on 103, but I don't think anyone's going to do that. And let's see. Oh, yeah, and just one final point. Just as I was sitting here, one of my colleagues sent an article that just appeared in the Wall Street Journal. It's headlined, California's Home Insurance Titanic, how the state underpriced its disaster risk. That's basically all it comes down to. Because of price controls, we underpriced disaster risk, and then insurers left rather than face the liabilities. So it's complicated, but it's simple. Thanks.
Okay. So next, okay, you got okay. Next, we have Professor Nancy Wallace from Berkeley, who is the professor and chair of the real estate group and has done a lot of work on, most recently, on modeling wildfire risk and its implications for mortgage markets. So.
Thank you. So I have 2 quick pictures. I guess academics can't resist having slides, especially when you're used to dealing with MBAs. So what I'm showing you here, what I do is I work on mortgage markets. And mortgage markets are priced. Everything about the pricing is based on probabilities. What's the probability that people default on their mortgage, given their characteristics? What's the probability that people prepay their mortgage before its maturity date? So all of this probability infrastructure drives the capital markets. And of course, mortgages, if you have a mortgage, your mortgage company is going to require property and casualty insurance. It's required. And if you don't have property and casualty insurance, or you're dropped from property and casualty insurance, they have the right to call your mortgage, to actually demand that the mortgage be paid back the day you receive the letter in full. So why I'm showing you these 2 pictures is just reflecting on our crisis in pricing mortgage, property and casualty insurance in the state, is what this is showing you is the loss ratios of the P&C companies in the state of California. as a result of the two really serious 2017-2018 fire periods, mostly summer wildfire, where the loss ratios are greater than 1. And the largest insurance company in the state right now is State Farm, and their current loss ratio is 144%. So when you look at what the performance, the direct underwriting profits from 2012 to 2021, in the US, they were about 3.6%, not super high. It's a challenging market across the country. But in California, they're negative 13.1%. So this is not a sustainable market. And most of these markets are based on probabilities. And that is what was not allowed to be used under Proposition 103, brought to us by Ralph Nader and other luminaries in the capital markets. The problem is, the rule was, up until the end of December of this last year, 2024, that the firms used a backward-looking average to determine their pricing eligibility and what would get approved, going through the conveners and going through the California Department of Insurance. So rather than looking forward to do pricing like we do in the rest of the capital markets, we look at what the trading in the treasury market looks like, and then we price forward. All of this is forward-looking. We had set up a market where everything was backward-looking. And it's backward-looking when this is what the dynamics of max temperature in the western region, a lot of this is the Nevada Basin, which is where most of our winds, both the Diablo and the Santanas, are coming from. And we have had 2 years of 0.3 centigrade increases in max temperature, and the scientists don't know why. But this is not going to go away. And so this stress on our insurance markets, unless we price reasonably, is basically not a solvable problem, and the firms have nothing to do but to leave the state. So what would happen if State Farm doesn't get its rate increase? So State Farm was downgraded last year, so it got a B rating. And it's headed, if it doesn't get its rate increase, for another download where it will no longer be eligible to provide P&C insurance for any mortgage insured by Fannie or Freddie. And about 90% of the mortgages originated in California are securitized by Fannie and Freddie. That would mean, as where I started this conversation, that all the lenders that are exposed to State Farm being downgraded to C would immediately accelerate the debt, which means that they would require all those borrowers to pay the mortgage back literally the day they receive the letter in the mail. This is not sustainable, and we really do need to think seriously about a careful probability catastrophe modeling for this market. And that's where the mortgage market is going. That's how I got to this kind of modeling, because of my work on mortgages. Because mortgages, who mortgage and P&C insurance is for, is the banks. I know most people think what they're concerned about is their protection of their property, but what's really being insured is the collateral on the debt. And so the banks have a huge incentive to care a lot about this. And so a lot of the mortgage market was invented in California. We are creative. We can come up with very effective, creative solutions to this. And part of the problem also goes back to what Steve was just talking about. We've heard a lot about mitigation. We've heard a lot about hardening homes. Hardening homes and mitigation, we've also heard about how costly it is expensive. The two key things, or there are three: the close around the house, the 5-foot break, the roof quality, is it a roof? Can it withstand all these embers that are coming from very high up, especially the large fires, landing on the roof? And does it have double pane glass, paned windows? Those three things are probably about to do them, given the average house in California is 45 years old, would probably cost between $22,000 and $50,000. What we don't have in California are second mortgages to allow people to do this mitigation. The loan market doesn't exist. Who would originate these mortgages? Well, obviously it would be the banks. It could also be insurance companies. They do a lot of lending, and this would benefit them. And then the third party would be, we could use a tax incremental finance mechanism, which California has the wherewithal to do it. We have laws that allow us to use tax liens to protect against some of these risks. Why are these potentially desirable mortgages? Because you can make them really long. So they're seated in your property tax. They're on the property, not the person. So when you buy or sell the property, the lien sits there on the house. So we could have very long maturity mortgages. We could seat them in the property taxes, and they're possible to use. So after the 1991 Oakland Hills fire, which we haven't heard about today, I was quite surprised. Everything's very modern, but that was a 3,000 home disaster. And what we did is we used Mello-Roos, which exists in California, where you can make each house a taxing jurisdiction, or you can get, we've heard about your comment about getting communities to work together. We also have the community assessment program, which is another use of Mello-Roos to repair the water mains that don't hold water pressure. That was a big problem in the 1991 Oakland Hills fire. And additionally, we could potentially use this for a second lien market. So I think we can rise to the occasion by using the creative elements that exist in California to build a capital market to help people do this mitigation. And I think if we don't, we are not going to have insurance companies. And if we don't have good insurance companies, we are not going to have access to the US mortgage market. So it's a rather sobering reality, and I think it will focus attention on what needs to be done, which is a mortgage market response to mitigation. Do you have pictures? Do you need this? Okay.
Okay.
Thanks.
Yes, that was sobering.
Sorry.
Yeah. Okay, so our last speaker for introductory remarks is Sarah Russell, who is over at Google X and has been thinking about predicting better to help insurance companies cope with the underwriting process.
I mean, this is spectacularly helpful, a group of 3 people. I'm trying to think of how I could potentially add here. I'm glad I brought no slides. I haven't been in academia for a while, so I have 0 slides. And this is what I think would be most useful. I was brought into Google X 6 years ago as an entrepreneur in residence, so I've been taking the approach to actually this from an entrepreneur's perspective, which is what's the market, what's the product market fit, what's scalable, right? That's been the approach. And I was originally interested in this question of pricing climate risk, because I thought if we could price climate risk, then maybe asset prices would change. Sort of along pricing natural capital a la Marshall Burke, this sort of value of understanding nature and so forth. Then I thought, well, who's the best in the world at pricing risk? Who thinks about risk? Who matches capital to risk? And that's the insurance industry. So I went to the insurance industry and they said, no, we don't think about climate change. No. I get bonused year over year. Like, that's not my job, And I said, well, what do you worry about? And they said, severe weather. And I said, oh, that's good. Okay, so tell me, in the severe weather world, what's the hardest for you to understand? And they said, wildfire. This was 5 years ago. They said the models are terrible, we don't understand any of them, and we all just try to run away from it. Thank goodness it's a secondary peril. Right? This is the attitude. So basically, the past several years, my team has been trying to solve this problem of forecasting wildfire risk. We thought about forecasting forward-looking models before we even knew what forward-looking models were. I mean, we just made fools of ourselves all over the place. Like Nancy, it's forgotten more than I will ever learn. This kind of approach. However, what has allowed us to do is get very close to the insurance customer, meaning exactly what is keeping the insurance industry out of this. And I do agree that 100%, the market failure in California is 100% on the side of the regulators and so forth. That market failure is real. And I agree that, Laura is coming around and whatever, we have some opportunities here, absolutely. But I would say the other part is if you actually talk to an insurance company, the actuaries, the underwriters, all the people who are on the buy side, for them it's not just the price of the insurance. It's actually fundamental, which is they just don't have risk appetite for wildfire the way they have for flood, the way they have for other natural disasters that maybe aren't as common. So what does that mean? What I'm saying is the risk appetite means an interest in understanding and learning more about wildfire across the United States or in California in ways that they believe will help them make money. Because that's their job, is to manage that loss ratio, make money, get bonus, predict risk well. And I think for many years they've looked at this space and said there's just not a lot of opportunity here for us to get really smart and to become expert. And so we're just going to keep our arm's length. And so many of them have come up with ways to not understand this risk very well. I mean, it's kind of funny. You ask them, how many different views of risk do you buy when it comes to flood? And they go to 8 different vendors. 8 different vendors to help them understand every perspective on the risk of flood in one home. You say, what do you do for fire? And they say, it's all garbage. We buy 2, maybe 3. I mean, they're just like not engaged, right? So this is part of our challenge is like, well, if they're buying 8 views of risk when it comes to flood, how do we get them more engaged around fire? Now, to be clear, you can absolutely talk to people in some of these insurance companies who are super riled up about fire. I'm just talking about the general gestalt. Because I come from Google, and at Google, everyone takes our call, right? Everyone takes the first call from Google, like they do from Stanford. Of course I'll talk to you. And then once it comes time for you to actually do something or talk about something, they're like, yeah, let me talk to my friend and underwriting, and they'll talk to my friend. You start to spread out, right? And then, but the actual action. So when it comes to the action, putting money against this and so forth, the path we have found most successful is the notion that there is actually very good risk in California. That there's many, many homes in California that are actually quite insurable because a probabilistic model shows that the wildfire risk is in fact lower than anyone thinks. Yeah. And that is so important because it actually gels very nicely with an AI-based approach, which is an AI sort of machine learning-based approach. How we evaluate it is based on something called an AUC, area under the receiver operating curve, blah, blah, blah. That AUC, as you all know, it hinges on your ability to predict very high risk as well as very low risk. So the better you are at identifying low risk, the overall quality of your model appears stronger. So this has been actually our most successful strategy, is the notion of getting very good at absolute probability risk and constructing portfolios of California that help them understand there's lots of good risk here. And why that's important is it's part of a good portfolio approach to risk, in your basket of risk. I have an appetite because I can get very good risk. I can get risk that's a little bit more on the edge. Oh, and guess what? Now this is on the edge. I'm going to go buy 4 different views of risk on this house. I'll buy 6 different views of risk. That's what we want, is more engagement, frankly. And then the other thing I'll say is on the unregulated side, there's an entire space called excess and surplus lines, which are not regulated by Laura in the same way. And that is really growing from a number of large insurers. And they're seeing it as an opportunity to get into this market in a way that allows them to test. Interestingly enough, we're helping to create one product here that's business interruption insurance, just based on the probability of smoke associated with fire. So we're saying businesses in this community, if a fire strikes, the odds that there's going to be an evacuation, that people won't come to their store, that people won't buy, that people won't come to the hotel. So they're actually buying business interruption insurance rather than actual, P&C insurance on the. So the interruption is around just the events and the economic impact of that fire. So that's the other approach we're taking. I hope that's helpful. So I guess the perspective is the closer you get to these customers, I think, they hide a little bit behind the regulatory failure, I would say. And we're still trying to get them over saying, that's not a good excuse anymore. Engage. And then when you get them engaged, I think it has been very successful to talk about the good risk here, because that creates a portfolio approach. And then finally, I think the opportunities around new kinds of products like excess and surplus lines are also interesting.
Well, there's a lot of stuff here, and I'm going to ask one question, but I'm going to call an audible and throw it out to the audience earlier, because there are a lot of excellent ideas here that I suspect there are people that can ask some good questions about. But I do want to go back to 2 points and have you guys all comment on it. One is, several of you acknowledge that when we're assessing risk, a key element of this is what the actual physical risk is of fire. And that's in the language of the sustainability school called attribution science. And we're pretty good at climate science, which is the average, which is the chart you showed. But the variation is actually what's going to kill us, because there are differences in temperature, there are differences in vegetation in terms of how quickly they dry out. The weather that you're getting, like the winds, there's nobody at Stanford that's really modeling that right now. I keep saying to people, I lived in Altadena, in that neighborhood that burned. All the homes around it burned. Somehow my house didn't, even though it was made all of wood with wood shingles. Never, when I was living there at Caltech, and there were fires out in the hills, did I ever believe that embers could fly. We never saw any embers because we never had winds that were 100 miles an hour. So how do we, I'm glad that we're trying to put probabilities on these things, but we have this underlying problem. And it seems to me somehow there has to be a better connection to what we're doing in the attribution science if you're going to have these models be successful. Which then gets me to the CAL FIRE question. You guys just changed those maps. And in fact, last I saw, you changed where my house is, and now I'm in a very high severity zone.
Yeah, we specifically
Hey,
moved
you know,
your
I
house.
had a feeling it was coming. So this is Half Moon Bay, which was previously fairly damp, but guess what? The temperature, one of the areas in which the temperature has been increasing the most is the Central Coast, which is a little bit of a surprise, okay? And that's why we got the fires down in, down near the Santa Cruz area. So tell us a little bit about these maps that you now have me enveloped in. Not that I'm complaining, but just what is the science and who was helping you put that together?
All right. So going back to Nancy's comment about the Oakland Hills fire of 1991, that's what created the fire hazard severity zones. It was the Bates bill that came out of that created fire hazard severity zones, which basically painted the state in these different zones. In the state responsibility area, which is out in the more in the urban areas than in the unincorporated areas, not the urban areas. We have three zones, moderate, high, and very high. And then there was a very high fire hazard severity zone in the LRA. And it was that way from 1992 from the Bates bill until SB 63 recently in 2020 required the Office of the State Fire Marshal to now map the moderate and the high in the LRA, the local responsibility area as well. So an important distinction to make is that we're mapping hazard, not risk. Oftentimes those words get used interchangeably, they get conflated, and they do not mean the same thing. Hazard to us is based on the physical condition that creates the likelihood of expected fire behavior over a 30 to 50 year period, not taking into account fuels reduction and those vegetation management, those types of things. So what we're saying is, for all intents and purposes, the reason that those zones are there is to say which mitigations need to take place in those areas. So in the SRA, all the things apply, meaning if you're going to build a home, you need to be compliant with Chapter 7A. You need to meet the state minimum fire safe regulations. You need to be compliant with defensible space. In the local responsibility area, in the very high, all three of those things still apply. So we're saying the hazard is such in those areas high enough that you need to do all the things. And that's what we're saying with the fire hazard severity zones. Now, when we talk about risk, it's the potential of the damage the fire can do under existing conditions. So in essence, you can live in a very high fire hazard severity zone and have almost zero risk because you've built your house out of concrete, you have a metal roof, you have no vegetation around your house, you have zero risk.
How many homes in California have that?
There are almost no homes like that. But my point is that you can do it. You can live in a very high fire hazard severity zone and almost eliminate. So what we're saying with the mitigations that we're asking to do, those three things, the minimum fire safe regulations, Chapter 7A, and defensible space, is to buy down your risk. You're not going to change your hazard. Your hazard is over 30 to 50 years, you're in an elevated hazard area. You need to do all the things to now buy down your risk. And that's where we need to get people to buy in on, if I do these things, my house, the things I treasure the most, have a less likelihood of being destroyed by wildfire if I do the things. So the maps, we finished the state responsibility area April 1st, 2024. It was the first time they'd been remapped since 2010. We'd been working on it since 2018 to do the remapping. The next question you asked was who helped us with that. Our Fire and Resource Assessment Program, or we call FRAP, has environmental scientists that helped us do the modeling. And we got the model peer reviewed by many scientists across the nation to ensure that what we incorporated in the model were things that were actually relevant. The differences between the previous model iteration and this one is exactly what Bruce was talking about, an ember transport model, which wasn't incorporated. Also incorporating microclimates for weather. Before, the state was painted with a really broad brush for climate and for weather across the state. What we know now is that every one of these communities has different climates within them and different microclimates. The one very distinctly different piece through the processes of the state responsibility area and the local responsibility area, the adoption process. The state responsibility area goes through public comment. There's iterations. People can comment on them, make suggestions. We relook at it. We go open it up to comment again. We relook at it. We open it up to comment again. Then we produce a final map. In the local responsibility area by government code 51178 at 178.5 and 179 does not allow for a public comment period at all. So the state fire marshal produces the map, we give it to the local jurisdiction then has a certain amount of time, 120 days, to adopt by ordinance that map. So two very different processes but accomplish the same thing by producing the maps, the same maps. So that's where we're at with the map rollout. We just finished the rollout for the LRA.
Okay. So here's a question that I have. One, almost certainly there are going to be a lot of people that are going to drop their insurance if this goes forward, okay? And secondly, there are a lot of people that aren't going to do, your neighbors aren't going to uniformly do all the things that you're supposed to do. Mm-hmm. And that there's an assumption here that the probability of your house going up is independent of what all the neighbors do. In fact, we know that's not true. So, I'm just wondering, are we going to have a stable market given these huge uncertainties? I mean, I understand the creativity, what you guys are talking about, but and what happens to the people that are, really, I mean, I can imagine upper middle class and middle class people can do this, but a lot of the market is people that are just barely making their mortgages. So are we going to be able with these mechanisms to handle those people as well?
No, but that's where the community assessment programs can work and the subsidies that are absolutely going to work for some of these new fragile populations because of the externalities that are generated from these other, like the edge of not just Altadena, but a little bit deeper in the canyon from Altadena. There are going to have to be subsidies from that. How will that be paid for? Well, we have SIEPR from wildfire. The missing element of this is what the responsibility of the insurance companies was in terms of providing discounts. We haven't worked on menus of different kinds of pricing. I mean, that's why the work that Google is doing is so important. That's what we do. I mean, it's been done in the mortgage market since forever. And we need to make menus so that people can choose across menus, and then at the bottom tier, there are going to have to be subsidies. But I'm much more confident in using pricing schemes to the extent we can in populations that can bear it, and then have a floor, and then provide subsidies that are reasonable. And also to target it. We heard it, I think you brought that up, that we can't just mitigate anywhere. That's why we really good measurement of where's the biggest benefit from mitigation. Partly is these maps, but the maps aren't very dynamic. No. And we need, things are moving fast, and so we need to target. We can use machine learning. We have huge tools to avail of ourselves of right now, and target where we focus this mortgage products, focus this subsidy, and try to build a floor under which we protect people.
You look like you want to say something.
Well, I mean, let's put out a totally orthogonal viewpoint here, which is I think it's a little unfair to put this on CAL FIRE exclusively. CAL FIRE doesn't own any land, right?
Yeah, that's correct.
I mean, that's a little unfair, right? I have to say also our perspective is when we've run the models, we think the neighborhood is where the action is. That the home, I mean, we've run some of our models at 6 centimeter resolution, and we find home hardening is helpful, but like once a fire, is going, if with a 90 mile an hour, I'm sorry, but like vents, no go. Like the thing is gonna burn.
Mm-hmm.
Well, plus there are neighborhoods where the homes, like Coffee Park, where the fire went over the 101, those homes are way too close to one another, and
they're
you're not going to
mobile
get the kind of
homes. Or they're
distance
mobile homes,
that they
right?
were
They're
testing.
mobile
Yeah.
homes made out of plastic,
Yeah,
so
well, there
they'll
you go.
burn.
Well, I guess my perspective is also that, who owns the land? It's the U.S. Forest Service. It's private landowners. I mean, if you want to mitigate 1 million acres a year, I personally think our energy, yes, we have to talk to homeowners, but I think we have to spend a huge amount of energy talking about how do we mobilize massive land management strategies.
Yeah,
Yeah,
Steve.
because government doesn't do a really good job managing anything, right? I mean, I remember a newspaper. Caltrans, the state's biggest slumlord. That was a big feature. But anyway, I remember once when I lived in LA County, we backed to all this open land, and it's a very wild-prone area. And the fire department gave us all these notices about taking care of our land. I'll make it quick. Well, we all did. We watered and everything. But who's taking care of the 8 feet high weeds that had gone uncut? Well, LA County Fire Department. And it was like, what it took to get them to do it, right? So it's not that they're ill-intentioned, I guess, but it's just that governments don't do a good job. So if we empower insurance markets, insurance will, when the insurance company tells me, that I need to cut back the brush.
I'm totally with you. I
Yeah.
just think, we would all agree, right?
Yeah,
That
right.
We need some federal activity, we need some state, we need some.
And we need some pricing.
And we need some pricing. I think it's
Yeah,
all, but
okay,
I just want everyone, like the home hardening story, we can't lead with that, I don't think. Right? No, you're not saying this.
I'm definitely
right? I
not
think we
saying
are
that.
generally saying that the story is about like these massive, massive, massive forests and massive unmanaged land and so forth, that big stands of Douglas fir trees,
But these fires don't just start in the national forest. I mean, we can start with the Oakland Hills fire, which was all
good point.
eucalyptus, and it was totally urban, completely urban.
Yeah.
And it was a 100-year event with the Diablo winds, and 3,000 houses were gone in like an afternoon.
Yeah, urban, yeah, for sure.
And
Okay, I lied, I guess, because we haven't got out to the audience.
Oh,
as
sorry.
a
Well,
promise.
what if we reform CEQA? I mean, how would that might
Well,
speed up the process?
yeah, we can
of
do that
clearing?
tomorrow, I'm sure.
Yeah, yes. Well,
Exactly.
we
Wait a minute, I think we
managed to
said
do
that
it for
10 years ago, yeah.
stadiums, but we can't do it for brush clearing.
All right, listen, this is, by the way, I knew this was going to be this way. I knew what the hazard was, that this could take
A
off.
moral hazard.
Yeah, and so I was quite excited about this panel. Okay, let's go to the audience, and all right, you got it up first, and we'll come right here. Okay, yep.
Hi, thanks for a great panel and a lot of creative ideas. But just kind of as I step back and look at the big picture, to me, the issue is there's not enough insurance capital in the market. And as long as we have Prop 103, it's not coming.
Yeah.
So, and you mentioned it's going to be hard to reverse 103. So, okay, so I think that's a fundamental issue that we have to deal with. So, but it's going to be a more complicated question. So the other way is, let's say the insurance commissioner allows rates to rise. Somehow we evade the Prop 103 question and we got the market rates kind of settling. I think if we run the math, we'll see that it'll be unaffordable. It's not going to be a subsidy for the small amount of people. I think we'll see 40, 50, 60% of the people will find it unaffordable to insure their homes to their fair value. So I think ultimately, as I kind of run through the different scenarios, I don't see a scenario that doesn't involve a general taxpayer solution. But I'd be interested in you guys commenting whether there's something beyond the government having to come in and actually subsidize the California market until maybe it stabilizes in 15 years and as competitive things drive down and home hardens, et cetera. But interested in comments on that.
Well, there's a lot that could be done within the Prop 103 framework, even though I think Prop 103 is awful. And so But like in any price control, if you have 40 years of price controls and then you eliminate the price controls, you're going to have a quick spike. But markets work really fast. I mean, we look at, we could look the separate issue, the Austin rental market. The prices soared like 80% right after COVID, and then they permitted a lot of building, and it fell. And that's what happens in markets. I mean, we already have 7 insurers who said they're going to expand their underwriting, and I'm sure State Farm will also if they figure out the this latest rate increase. That then we're going to have companies swarming in, and then prices are going to go up for a little while, and then they're going to go down. That's my thinking.
Nancy, did you want to jump in?
And there are other things we can explore. Like Prop 103 doesn't allow tail risk insurance. So we're not helping the firms include the rate increases. I mean, you talked about primary, when it became a bundled risk and when they unbundled it, it was in the reinsurance markets where that happened. And we don't allow our firms to do reinsurance or haven't up until December of 2024. So that also could be explored. I mean, we could also do parametric insurance. I mean, other countries have relied on that, and that's not allowed either. So I think before we say that all has to be produced by the government, some of these other methods that are used successfully in other countries, Australia massively uses reinsurance for their P&C market, and we don't use it at all.
Yeah,
So I
we
think
should
there are a
remember
lot
that
of other
103 was
options.
passed in a completely different climate era.
Totally, I agree with you.
and-
I agree.
You know. Let's get some other questions right here. Yeah.
This question is primarily for Sarah. So you mentioned the insurance companies not trusting, I guess, the wildfire models. What is it about those models that they don't like? And how is it that you're going to convince them that your models are effective about the risk?
Well, you know, how I convince them that I try to improve upon with every phone call. But so there's a fire triangle, which is, you know, the vegetation, the weather, the terrain. And so these are inputs. What's the state of the land? What's the state of the weather? What's the weather going to look like? And what's the state of the structure? What's the terrain? And essentially, if you have crap inputs for each of those, you have a bad sense of weather, you have really coarse understanding of the vegetation, you haven't updated it in 5 years, and your understanding of structures is really outdated, all of those factors lead to a worse outcome. What's more is historically, because of regulators and all the sort of structure, the inability to use a forward-looking model, these historical models have relied on physics-based approaches. The physics-based approach are just very brittle. They don't accommodate dynamic inputs very well, and you have to have every damn input to answer a physics-based question. And in machine learning, if there's a little, you know, opening in the data, it'll kind of smooth over it and figure it out, right? Which, of course, makes people anxious. Is it a black box? But guess what? You can use some statistical methods that allow you to ask the model, why did you call it this? And that's the approach we took. It's a little less sexy, but it allows us, when an insurance company says, why did you call this 14%? That's insanely high. 14% probability you'll be in a fire 1 year ahead. We say, well, the model is saying it's because it's, you know, at the top of a hill, it's, you know, 10 miles from a fire suppression, and the U.S. Forest Service called it this, and we can give it a bunch of explanations and so forth. So part of the convincing is showing them the model, like letting them, you know, open up the hood. And then there's a lot of ways in which you can demonstrate a probabilistic model is more accurate, you know, with some good sampling strategies. So we do sort of an out-of-sample test, and then we look at the future. But there's lots of different approaches to validate that your probabilistic model is more accurate. But in general, the physics-based approach is one that's cherished by fire science people. I mean, they
And by
love
physicists.
and physicists. They love, like, what's that centimeter of land going to look like there and then there, you know? And it's just, you can't fight it. So we're trying to. I'm being sarcastic. You know what I'm
Well,
saying?
you don't have to worry. We didn't invite any physicists.
Right?
So.
Bruce, may I add to Michael's question?
Sure.
You know, we of course, we've been modeling hazard for a few years now, and there's some legislation pending that would require the state, CAL FIRE, and actually a parallel bill, one in Assembly, one in the Senate, that would require the Department of Insurance to do a full holistic risk model across the state for, you know, related to wildfire. One of the bills charges me specifically, the deputy director to do it, which is exciting. But AB 326, I believe, either AB 326 or SB 326. One, two, it's 326. What is tough about risk modeling is you need to have a clear view of every parcel. And every house is different. Every house is different. And the things that I call crap, which I'm told I can't do, they're called treasures, that people keep around their house, is different for every person. And those either hydrocarbon-based materials or organic materials that people have put are different around every home. And it becomes very hard to model in every wind factor, in every type of terrain, in every type of house, how that is going to move through that given neighborhood. So yes, and probabilistic is we kind of get an idea, but when you actually want to put people in a zone, in a risk model, and say, look, now you're at this risk level, you need to be really sure. And it's hard to be sure when you don't have to Sarah's point, the recurrence of being able to see those things on a routine basis. So one day people might not have anything around their house, and then the next day they did some construction stuff, and now they have a whole bunch of stuff around their house. Now their risk just went way up, because if embers come and fly against that, now they're more susceptible. So that risk changes every day, every hour of every day, depending on the wind, the amount of material that gets blown. Imagine it's trash day. You set your trash cans out on the side of the road. The wind is such that it blows the trash cans over, and all the stuff blows out of the trash cans, and now it blows up against your house that you take immaculate care of, and now you're susceptible to more wildfire because you have a huge collection of trash next to your house. Like, those things are almost impossible to model, and it becomes very difficult to say, yes, this is what's going to happen. And
Not to mention the people that leave the garage door open.
or windows open. I saw that in the Eaton fire, where several of the second-story windows for ventilation were still open on homes that were mostly damaged, where the fire got into them. It's, for some reason, they were able to be saved. So,
I think we're down to the last 24 seconds, which is just enough time to thank all of them for an excellent panel.
Thank you. Really good, thanks.
good job.
So you can go 1 year out.
Thank you, Bruce. Thanks to the panelists for finishing off the day on a high note. So I want to thank all of you, all the panelists throughout the day, for what I think was a engaging, productive discussion on an issue that I know we will be grappling with for months, for years, and for decades to come. We have refreshments in the lobby. So thanks all the panelists again for a wonderful day.